to Nirmal Bang, ladies and gentlemen. I'm Dadia. We have Vikas Thompson, Nanam, MD and Global CEO at 3i Infotech joining in. Welcome to the show, Thompson. Always a pleasure to speak to you and get insights from you. Thompson, my question coming to you is overall, what is, the current investments that we've made in the run and grow strategy? And what are the kind of incremental funds going into this on a quarterly or a half-yearly basis?
Yeah. Thanks for that question, because in fact, running up from our Q3 results, our investor call, I've been trying to kind of, explain to our shareholders and investors, the important point 3i is going through. This is a very important inflection point. The way I look at it, the new 3i is more like a startup, because the last 9 months, 3 quarters to the fourth quarter, post the product, carve out, and what we inherited as the services business is what we call as the run business, as you rightly pointed out. And that is very important for us because it ultimately pays our bills. So fundamentally, the run business, we want to try and see how to run it more efficiently. So that's the very important focus area. And to your point, from an investment perspective, in our run business, these are more like 2 parts of it. One is the type of business we inherited. The second, also the type of service lines we used to cater before. Because as a product-led company, services was not the main forte. Though it was an independent unit, it was a product-led company and not comparable with a 100% services company which you see in the industry. So it's a very unique scenario to be in. Now, as we evolve to your core question on investments, if you ask me, in the run business, we are now trying to invest on next generation technologies, which we want to kind of take it to the market and grow. So fundamentally, we are investing on ourselves and try and see if we can run our business more efficiently so that the focus is to drive more margins. That's one. The second, in grow business, to your latter part of the question, is where we want to be a challenger to the peers in the market or other services companies. Because today, if you look at it, we are evolving into a services-led company predominantly because we don't have products right now and we need to compete and challenge our existing services peers. So grow is something where we want to be ahead of the curve. So the investment we are making would be more on, cloud first, digital first, automation led go-to-market. So that's what we are doing in the grow part of it. So typically, our opportunity to grow will be to cannibalize and challenge our peers. That's the only way we can survive. So that's our focus area. And to your point, just to summarize that question on the grow part of it, we are investing in our NewRay branded services. You've seen a lot of buzz around it in terms of NewRay. NewRay stands for cloud, so it's all cloud first. Very clearly, we have a Oracle go-to-market, which we are partnering with Oracle. We are building an Oracle COE, which is what we called as NewRay 3i Plus, which is very, very kind of an arrowhead offering. And NewRay 3i is a non-Oracle offering, which we work on any other bare metal. And we have hyperscalers, which we are investing. The unique secret sauce, we look at it, is also working with the startup ecosystem. Work with unique startups, give them the opportunity to work with us. And then we build our IP around it, is where even in the grow, for example, as we speak, we have launched our NewRay Edge product, which is a SaaS product. So these are some of the investments we are making in the cloud first. Similarly, in our automation COEs, our analytics COEs is where we are now trying to kind of move forward. And finally, one of our arrowheads have been testing services. In testing, we are investing in cognitive testing. It's not just digital assurance, but we want to kind of challenge the market with cognitive self-scripting testing services, which is our Flexib productized platform by which we want to take it. So broadly, that's where we are investing. The entire build portion is a different, as I've been speaking, the run, grow, and build. The build is for the future. So grow is for tomorrow. The build is for the future, where we want to build for maybe tomorrow. And that, I think, we are investing in edge computing and 5G, which you are aware of it. You're on mute, I guess. You're on mute, I guess.
So overall, when you see in terms of the expansion plans as well, what does it look like over the next 2 to 3 years? And for how long are we expecting the legacy expenses to continue?
Yeah, very interesting. You got two questions, two parts of it. I'll try and answer the latter first, because that is of immediate interest. Because if you look at it, what we have done, two things we have done. One is, it was almost like an extremely aggressive carve out the company had done, because April 1st, the new team took over, the product division was spun off. So obviously there were a lot of, and the company was also coming out of a CDR also. We had to pay back our, creditors. There's a lot of preferentiality. So it's too many things happening at the same time. So Q1, Q2 was more of a kind of a stabilization period where we are there are a lot of overflow costs, deal-related costs, one-time expenses, legacy expenses, which happen, right? That is all done. And Q3, what we did to build a strong, healthier organization, we wanted to focus on our fundamentals. So we wanted to kind of clean it up, bring in the best-in-class global risk and compliance kind of methodologies. So we kind of started doing proactively providing for slow-moving debts and a lot of stuff which we had done, which is like more like a one-time cleanup to ensure that we don't have surprises. To answer your question, I think we have reached the bottom of the lake, and I don't foresee any surprises anymore for us. We kind of got a very clear handle on where we are in terms of that. So most likely, most of the legacy expenses are kind of captured, but still, if you look at it, we are a 25-year-old company. There's so much of legacy there, and I'm sure we are not going to get any more surprises in the future. On the second part, going back to your earlier part of the question, I think you kind of asked two questions together. One is you spoke about the growth, right? In terms of for the next 2-3 years is your question correct? The first part of the question. Yeah, the first.
Right. So overall from here on, if you see in terms of business, what's the current order book looking like, and what could it look like at the end of the year or in the next 12 to 18 months?
Yeah, so I'll try and answer that with your previous question also, because I didn't completely answer it and along with this. So if you look at it from a growth perspective, what we are doing as an organization is it's a very careful balance. On one side, we need to retain our run business, run it more efficiently, and then slowly ramping up our grow business. So the grow business, which we are talking about, is going to be automation, digital-led, more of humanoid. So the focus is higher gross margin. We'll have to cannibalize another peer company's top line. That's the only way we'll get it. So somebody does with 100 people, we'll be able to do 50 people because we have superior cognitive technology. That's the only way we can disrupt. But what happens is it disrupts the top line of a competitor, but also gives us more margin. So that is one. The second also, what we are trying to do is also, even on some of the large deals we have won right now, the approach we are taking is we are trying to be a one-stop shop. We are telling our customers, we are a one-stop shop. Whether you don't need a separate cloud services provider. You don't need a separate managed services provider. You don't need a separate cloud transformation provider. We are a one-stop shop. You give us the entire budget, we'll optimize the cost. We'll bring in the best-in-class technology. It's a win-win for both of us. That is one. Second, we are also engineering the entire commercial engagement models. We are disrupting, going away from the typical FTE models and all those comfort zone models to aligning to our customers' KPI. So for example, they say, I'm charging my customers per customer. Why don't you also charge? So we are aligning with that. So the models are changing from fixed bid, all these kinds of comfortable models to more skin in the game model. So that's a very clear change. To your again, a very clear question asked, what is the type of order book we are looking at? So literally, at least, maybe definitely the end of the year is now almost there. We are ending the quarter because I don't want to be giving, but from a high level guidance perspective, we'll also have a separate guidance call we want to do. At least this year, by going, in fact, I spoke about it in Q3, we gave a kind of a guidance. We at least, hopefully, this is a very important month. We want to kind of, we last year, I think the company exited at 608 crores pure services business minus the product. I think, we should at least definitely grow with all these turmoil, minimum 10% exit for this year. And then secondly, I think the order book for next year, as we speak to you right now, the grow business is where we are focusing, which is the better margin, better TCV values and stuff like that. So at least as we speak right now, we have a clear visibility of at least around 50 to 60 crores of order book over and above our current, which is there, and it's still billing. And March is a very important month for all of us. We are all working hard to book as much as possible to get in backlog of revenues. So even recently we won a large deal from Rajasthan Pollution Board as well. It's a very prestigious deal also. We won, which is almost 12 to 13 crores of business. It's a good step forward. And we also won the large deal in US as well, which is a $20 million 5-year contract in cloud. So which will at least give us for this year, we are hoping we'll at least recognize this next year. I'm saying the next financial year, we'll recognize around 3 to 4 million of revenues also. These are public domain data, which is there. So broadly, that's how we look. To your question, even when I took over and setting the direction, I said two things. In the long term, we said by 2030, we want to be $1 billion company. Short term, in 3 years, already I think now 10 months are gone. I promised I will create a 1,000 crore company with 100 crores PBT. So that's the task we have set for ourselves, and we are working very hard in that direction because we want to create an extremely foundationally strong, highly profitable organization.
Right. So overall, Thompson, if you have to see in terms of where business goes, what's the kind of growth are we expecting in terms of the next 12 to 18 months? Because most of the IT companies are growing by 15 to 20% as per guidances given by them. So what are we looking at?
See, for us, just to set expectations, as I said, the first step for us is to get on par with peers. See, because since we are a product-led company and the services was a secondary function, where I'm coming from. So our start point is not very similar to other services company. I've explained this. That's the reason for our low profitability. We have more onshore revenues than offshore. That's my problem statement number one. If you look at it, 80% of my revenues are onshore and only 20% is offshore. So the mix change is very important for us. So for us, it's like 2-3 things. As we are giving a guidance in terms of growth, the important point is also to change the revenue mix, which is very important for all of us. Because right from our shareholders to organization, everybody, the value will get only created if this mix changes. So it's a very interesting problem to have. And it's good for us also. And that's why I'm saying it is also linked to which pushes us for alternate business models. Because if you look at it, 3i has kind of lost a decade. 3i used to be $1 billion company in 2008. Okay. Now we've kind of lost a lot of time and we are trying to rebuild again. So literally we have to innovate ourselves to kind of, get ahead of the curve or, get back into the race very fast. But to come back to your core question, which I even spoke some time back, in some of my interviews, definitely we would want to target in the real time in the next 12 to 18 months, because I promised 1,000 crores in 3 years. At least we should hit 850 crores in terms of, top line numbers is what we want to kind of, aim at as an organization.
Right. So that seems like a good journey that we are on once again. Thank you, Thompson, so much for joining us on the show. It's always a pleasure to speak to you, get insights. Thank you. Stay safe and speak to you soon again.
Thank you, Haral. Take care. Yeah, bye-bye.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.